Welcome to the Motley Fool's Crunch Time series, where we scout out a single company from the story to the opportunities and the risks. Today, we're going to take a look at SoFi Technologies. I'll start with my prediction. I think SoFi, it's already become the preferred banking and financial services partner for over 9 million people, is primed to beat the market over the next 5 years. SoFi makes most of its money from interest earned on its lending products and also from fees on financial services it provides. Its business strategy is to attract new customers with a range of incentives. This includes high yields on its banking products, appealing rewards on credit cards, easy and low cost trading and investing, all through the convenience of one of the best banking and finance apps out there. The strategy can be expensive though. SoFi pays a lot in customer acquisition. Its average cost of funding assets, which is basically what it pays in yield on deposits and also interest on loans that it's taken out, is 53% higher than JP Morgan Chase and almost 70% more than Bank of America. But unlike those legacy competitors, SoFi is playing a little bit of a different game. Its balance sheet, unlike its big peers, isn't laden with mortgages yielding less than 3%. That means it's better positioned to pay those higher yields on deposits and take the cash and lend it at even higher rates. Since its loan book is mostly student loans and personal loans that pay a higher interest rate, the strategy seems to be working. It's also tiny in comparison to most banks that have a national footprint with about $34 billion in assets. That means it has plenty of room to continue growing. We've seen the growth play out too. Member growth has been above 25% every single quarter since 2020. It also has a payments platform for other fintechs called Galileo that has also been a big growth driver. Accounts continue to grow at a double-digit rate, and segment contribution profit has more than doubled since the first quarter of 2023. We do need to talk about how things could go wrong. As a bank, SoFi faces significant risk if a large number of borrowers default on their loans. About 70% of its loan book is those student and personal loans. So there's not a car or a home that it could repossess to offset loan losses if a borrower defaults. That means one of its profitability advantages also makes it higher risk than other commercial banks. Now, this is offset some by SoFi's lower risk pool of borrowers. There's also execution risk. So far, CEO Anthony Noto and his team done a great job managing lending risk and also growing. It's important that they continue to prioritize responsible underwriting and maintaining a strong capital structure. Banks are really leveraged. It means when things go bad, they tend to go bad spectacularly. My prediction is that SoFi will do spectacularly well over the next 5 years. 2024 has been a transformative year. The company's not only reached profitability, it's done it faster than expected, beating management's own expectations. Combine that excellent business performance and strong growth with a stock that's not particularly expensive, I think SoFi is primed to be a winning stock going forward. Now, at the Motley Fool, your comments make us smarter. Please comment with your own research and insights about SoFi Technologies. Plus, tell us what stock you might want to see us tackle next. Also, go to fool.com/invest to receive the top 10 best stocks to buy now.